Buffett's success mantra has been his continuous focus on firm products and their capacity to generate profits. Stock market corrections can be unsettling. After all, who wants to watch the value of their investments collapse by thousands of dollars? However, many investors fail to recognize that these are the times when wealth is truly created. Long-term investors like Warren Buffett enjoy crashes and corrections, so here are 5 pieces of advice from the Oracle of Omaha himself that you can use to your own approach and use this correction to set yourself up for success in the long run. Don't sell in a panic. If history is any guide, stock market corrections and even crashes are an entirely standard component of a healthy stock market, and even investors who buy at the worst possible moments end up gaining in the long run. Your losses are simply on paper during a correction. They become real, though, if you decide to cut your losses and sell, as Warren Buffett has stated regarding investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. There are several compelling reasons to sell a stock at a loss. For example, if something fundamentally changed about a stock and your initial reasons for purchasing it no longer applied, selling it may be appropriate. Selling a stock you still believe in for the long term because you're worried it may fall more is one of the worst investment decisions you can make. The primary purpose of investing is to purchase low and sell high, but panic selling after a downturn is the polar opposite of this. Buffett understands that in most circumstances, buying and holding is the best investment approach, regardless of market conditions. Purchase low-cost stocks. Instead of seeing a market drop as an excuse to panic and sell, use it as an opportunity to buy up on your favorite companies at a discount. Whether it's socks or stocks, Buffett says, I appreciate buying great items when it's marked down. What he's suggesting is that investors should treat corrections like a bargain at their favorite retailer. As of January 13th, the market as a whole has been marked down by around 7% from where it was less than 2 weeks ago. Thus, now is a good time to buy. Wait a minute, couldn't the market fall even further? Of course, that is possible. Then there'll be another sale. That's why putting all of your money into the stock at once is often a wrong decision. What do you buy when you have these rare opportunities? One must grasp what the business's economics are likely to look like in 10 or 20 years. Warren's example is that you already know what Wrigley's chewing gum will look like in 10 years. The internet will not impact how people chew gum. It will have no effect on which gum they chew. Even if Wrigley's chewing gum faces some competition, his sales forecasts for this product are not far off. He understands the company's operations and business aspects, therefore, he sticks to what he knows. You should never invest in a single company if you don't understand it, no matter how inexpensive it is. Stick with it. Avoid the noise. Some of Buffett's astute investment decisions occurred during market downturns. During the 2008 financial crisis, Berkshire Hathaway purchased Goldman Sachs shares. The multinational investment bank required capital. One of the most common mistakes made by investors, according to Buffett, is paying too much attention to commentators, political turmoil, or market whispers. If he had listened to market forecasts, he would have lost concentration and missed out on a great buying opportunity. Berkshire received $3.7 billion from the Goldman Sachs stake in 2011, with dividends accounting for 34% of the total $1.27 billion. Those who invest solely when commentators are enthusiastic end up paying a high price for meaningless assurance, Buffett commented in 2009. Always keep the long term in mind. When the market crashes, the herd loses all rationality and panics, triggering a negative cycle as more people rush to sell at the same time. If you're the sort to invest for the long term, your money will be in the market in 10 years. Investing in recessions is easier if you realize that you'll be in it for the long haul. Investing at a low rate of return without monitoring or checking on it ensures a profit in the long run, whether you retire in 10, 20, or 30 years. Whether you agree with every facet of Buffett's investment plan or not, one thing is for sure. This man knows how to survive adversity. And that's it for the video. Don't forget to like, share, and subscribe to our channel for more such content.